AGNC is raising $2 billion. Is it a masterstroke or a warning? AGNC Investment Corp has officially activated a $2 billion at-the-market equity program. This isn't a traditional one-time offering, but a flexible tool for capital management. By partnering with 15 investment banks, AGNC can issue shares on a best efforts basis. The bull case argues this is a strategic catalyst for scaling their agency MBS portfolio. For a mortgage REIT, common equity is the primary engine for leverage and yield generation. This $2 billion runway provides the dry powder needed to capture expanding margins. Management can now opportunistically issue shares when equity valuations are most favorable to them. This effectively lowers the blended cost of capital while fortifying the overall balance sheet. It allows AGNC to optimize portfolio duration without relying on expensive short-term debt financing. Furthermore, this flexibility supports dividend sustainability in a volatile interest rate environment. However, we must examine the antithesis. Is this actually a desperate liquidity lifeline? The sheer size of the program could be an implicit admission of financial stress. Critics argue that the agency MBS portfolio is vulnerable to a flattening net interest margin. The company may need this cash to cover maturing debt or meet urgent margin calls. The best efforts language means shares could be sold at distressed prices, eroding the NAV value. This creates a significant overhang of dilution risk for every existing common shareholder. If the market is used as a backstop, the per-share value will inevitably decline. The risk is that the dividend becomes unsustainable without continual, dilutive equity infusions. We are seeing a tension between a growth catalyst and a defensive shield. Investors must weigh the benefit of a stronger balance sheet against the dilution risk. The success of this program depends on the timing of the share issuances. If AGNC sells into strength, they optimize their ROE and enhance competitive positioning. But if they sell into weakness, they are merely plugging a hole in the balance sheet. The agency MBS space remains highly sensitive to the Federal Reserve's rate path. This ATM program gives them the agility to navigate those shifts more effectively. Ultimately, the market will decide if this is a signal of confidence or desperation. Watch the NASET value per share as the first tranches of equity hit. The outcome will determine if AGNC can deliver sustainable long-term shareholder value. This $2 billion move is a pivotal shift in their capital management strategy. Whether it's a masterstroke or a warning, the impact on the stock is imminent.